Welcome to the Mr. R Show, presented by the MRR Institute. This podcast is designed specifically for tax professionals looking to scale and modernize their practice by maximizing revenue through resources. Join us as we explore expert strategies, innovative tools, and actionable advice to help you navigate the evolving landscape of the tax industry. Whether you're aiming to grow your business or enhance your client experience, you're in the right place. Now, let's get to the show and transform your practice together.
Hey everybody, and welcome back to the Mr. R Show here, brought to you, we'll say produced, edited, whatever we want to call it, by the MRR Institute. But why you're here, right? I'm sure it's for the free CPE, but I promise at the end of this, you're going to take a little bit more with you back to your practice than just 50 some odd minutes of time doing something else. So put down the coffee for now. We don't want you to have too much energy, but do grab a pen maybe and a little piece of paper, or even this, if you have an old tax return, maybe of a really bad client. No, we're going to leave that alone. We're not going to do that. But our topic today, we are going to look at the One Big Beautiful Bill Act again. So that OB3, we're going to dive into some specifics on it with our guest. But you don't want to hear from me, I promise. Chris Picciurro, welcome back, sir, to your own show. How you doing?
I'm doing great. Thanks, John. It's always a pleasure to be back on the Mr. R Show. Tax professionals, welcome back. And we are all in the process of digesting OB3. We're going to focus this month's episode on individual tax provisions. We have a special guest. And so the fact that you're getting this podcast complimentary, you should be honored, right? Because the special guest this month is Kelly Bender, enrolled agent based out of Pennsylvania. And Kelly and I have been teaching tax season updates for the last few years, but she is an amazing presenter, has spoke all over the country, and I always enjoy her sessions. And what I really enjoy about her as well is that she takes a very entrepreneurial mindset as a tax professional. We know a lot of the folks out in the tax and accounting community, we're really, really good at the technical part of tax preparation, accounting, bookkeeping, et cetera, et cetera. But sometimes we struggle with that entrepreneurial aspect. So she brings a wealth of knowledge, a ton of great experience, and we're going to get a little more personal history. But Kelly, welcome to the Mr. R Show. Thanks for joining us.
Thanks, Chris. Yeah, I always joke I'm an entrepreneur who just happens to be an accountant. So I think that bodes well for me. I am a little bit of a tax nerd, or maybe a lot of a tax nerd, but I'm also definitely a business junkie. And so that is certainly my passion, to help other, not just accountants, but all entrepreneurs run more effective businesses. And so I appreciate that little shout out. That is kind of what I ooze and bleed on most days.
And even though this episode's focused on individual tax provisions, many, many items bleed into businesses. And Kelly, I want to get a little more history about your practice. I love your practice, and I had the pleasure of meeting many members of your team, which many of them are actually your family members, which I think is pretty awesome. But as you know, Kelly, there's no separation of church and state when you're a business owner. So many of the people listening, the tax professionals listening, have those clients, and these individual tax provisions are going to affect them. But those clients also own businesses or rental property. So yeah, tell us about what's special about your practice and some of it. And you're actually another podcast hostess, I should say, as well.
Yeah. Well, so for our practice, we do work primarily with small business owners, and we really focus on supporting them through all the ages and stages of life. So from that baby business owner, that person who is just like getting started, I very soon have like a book coming out where I kind of approach what that baby business owner, that first set of questions and things you have to do, all the way to exit. And I deal a lot with aging business owners who, as you know, yes, are both, intertwined with personal and business, and then are moving on to the next phase, whether that be retirement or on to the next stage, and moving through an exit. And so we really work through that with all of our clients. And so we primarily focus with that small business owner clients. And we always say we understand them because we are them. And so It's just kind of, yes, you mentioned a lot of our employees are actually family or somehow related to us, and that does make it special and challenging. And but again, everybody's building for the same purposes,
Mhm.
which is really kind of cool. I think that we're actually a stronger family because we're building together.
Oh, and that's how many of our clients as tax professionals um, operate. You know,
Yeah.
so do you now with your family? Do sometimes the conversations around the holiday dinner table get into business, or do you guys kind of shut that down when you walk through the door and focus on other things? If is it hard to turn that part off?
I don't know. I mean, you've met me in person and see me. I don't really have an off switch. So for me, pretty much everything intertwined into almost every part of our lives has something to do with business, but it's not in a way that is like we can turn it off if need be. It's not like we're coming home and griping about clients or something like that. It's usually related to what's, a potential opportunity or just different things that we've all encountered, and all of us try to encourage everybody around us to be kind of active learners and readers and consumers of the next big things and finding new innovative ways to be better. So it usually has some overlap, I would say, in all ways, but you know, I don't get any complaints. So maybe sometimes very, very late at night, my husband will be like, "Can you please turn it off?" But
Right. Have you ever, and then we're going to jump in. Have you had a situation where personality wise, certain clients gravitate to someone else and away from someone else? I could tell you with my business partner, who we talk a lot, there are some clients that just love him way more. Yeah. And which is great. Like and then some tend to gravitate towards my personality. We're very complimentary in that way, but
yeah, I think that's anybody. I mean, everyone has their own special sauce. Everybody's unique in the way that they experience and communicate with others. So, certainly some of us maybe have different pros and cons that people love us or dislike us a little bit more. But, I think that's what makes everybody so unique. Everybody can There's no one right way to formula to success too. So even for accountants, like we can all be um meeting the needs of our clients in our own individual unique way. We don't have to change who we are to do that, but certainly some people. I think some people like me a little bit more, but my team's really great. So I love when somebody tells me they actually love somebody on my team more than me.
right.
I think that's actually a personal compliment. So
No, that is great. And the other thing we have to mention is that you and I, like 2 weeks after this bill passed, maybe three, were able to see each other at a conference, and we agreed this will be referred to as OB3 in our
that is
lives.
correct. There is no other terminology that is correct. This absolutely is OB3, and if you say anything else, you're wrong.
We'll see how this goes on the TSU routes. We're gonna find out. We could get some. They like to hand out snacks and stuff. So hopefully, no one chucks an apple at us or a donut or something like that. But
I'm quick. I'll duck.
yeah, we're still pretty mobile. Well, so this we're going to talk through, you know, not just the tax law changes, but kind of how you think that's going to affect different segments of taxpayers. Maybe drop a tidbit on. I know you do a lot of tax planning and strategy as well. Ideas that a tax professional could take to their clients. So this is going to it's going to be there for tax professionals to either learn something new, to maybe reinforce something that they've researched but just haven't had someone talk through it, and then maybe some practical applications. We're going to talk about some of the effective changes for 2025, some of the changes for 26, what are permanent changes, what are temporary changes. There'll be a little bit of overlap um, because something could be in 26 but temporary, 25 and permanent. And then we're going to kind of wrap up with some takeaways and some ideas as practitioners. So let's jump into 2025 effective changes. One big one that I personally didn't see coming was the car loan interest deduction. Um, I guess, the federal government wanted to play nice with Ford and General Motors and Chrysler, whoever wants to assemble a vehicle in this country. But this is a pretty big deduction for some people.
Yeah, this one is going to be interesting. So this is a brand new type of deduction. So for our practitioners here, we are going to commonly refer to, I think, this car loan interest and a number of other ones that we talked about that are going to be in this sort of middle ground where they're deductions after AGI,
Right.
but not subject to itemized. And so this is one of those, right? Is that this is
Yeah,
another
and
one of the
Kelly,
middle ground ones?
I mistakenly called this deduction and a couple of these other ones above the line at a presentation, just because in my mind I'm thinking, well, it's not an itemized deduction, and I was quickly reprimanded. Felt like I was back at elementary school and someone slapped me with a ruler. So I've changed how I frame this to it's a deduction for non-itemizers. Um, Someone that's might be a church attendee. Think about it, could be a purgatory deduction. It's somewhere in the middle.
Yeah, I'm calling them between the lines because like you said, yes, there's lots of people who love to be very technical. And the way to understand this is, we first have to have a test for adjusted gross income
Correct.
for whether or not we're going to qualify for this deduction. And then if we meet certain AGI limits, then we're going to be able to take this deduction, regardless of whether we then take standard or itemized deductions for the second part. So it's kind of like a between the line test. And a lot of this is going to have a lot of circular calculations. So I don't want to get too hung up in that, but we could unpack what the heck this deduction is, right? So this car loan interest, and you have outlined that it's going to be for these new vehicle loans, and it's the interest paid on the loan. But there's some caveats. So obviously I mentioned we have an AGI limitation on this one. So we've got, once we get over, it looks like 100 or 200 single or married joint, we're going to have some limitations that kick in. But the big caveat is the vehicle then has to be assembled in the US. So back to your point, the incentive structure here from the government putting this deduction out is that they want taxpayers to buy vehicles that are final manufactured in and assembled in the United States, right? So it's sort of this America First type philosophy with car loans. And then if there's interest on the loan, you're going to get to take the deduction. Now, that's up to $10,000, but I got to be honest, I don't know how many people I'm going to see with a $10,000 interest on a car loan, or maybe I am unaware of how expensive cars are, but that seems like a lot of money to me. So I don't think we'll see dollar amounts that high, but that's how it's going to look.
I agree. This could be in that what I call the all hat and no cattle category. So, for instance, if you had someone with over $10,000 of car loan interest, chances are they're over the income threshold, or at least I hope you are.
Yeah.
There's a lot to commit to your vehicle.
Yeah, because that's like $1,000 a month.
Of interest, right? But hey, you know what's going to happen is when you're shopping for that new vehicle, the salesperson is now going to be able to say, they're going to line up, Kelly, with your favorite people, the people that used to knock on doors and sell like solar or new window dressings or doors and windows. But you get a tax credit of, a whopping $150 or some crummy, remember those old energy credits. So you're going to be able to say, you know what, the interest on this vehicle is tax deductible. Doesn't mean you could, and that's something, as tax pros, we need to be aware of that. Just because something's tax deductible doesn't mean that a taxpayer could deduct it on their tax return. There, like you mentioned, there are phase outs.
Yeah, I mean, I can't wait for this because nothing to me says recipe for success than a car dealership giving tax advice. And so I am so excited for how this is going to play out in real time when it comes to tax
Well, I
season.
think John's excited because, this does apply to motorcycles. He might fire up a motorcycle again. I know he sold his baby before.
I never even thought about that. Maybe we'll get like a fleet for myself.
There you go.
Yeah.
I should caveat, because you did mention that maybe not everybody sees this. I start all conversations with a heavy dose of sarcasm. So if you thought I was serious there, please understand that my facial expression tells a different story. I should,
That's what makes it fun. Makes it fun and interesting.
put that disclaimer in there.
All right, here's another, and again, these are going to be major provisions for individuals. We're not going to hit everyone. I'd rather touch on less and put some context and some color to it, for lack of a better term. This one has been very popular, the no tax on overtime deduction. And it does come with caveats as well. What kind of like, I mean, here's the first thing. What the heck's overtime? Where,
Yeah, this one's this one's gonna be fun. Mostly for 2025. Now remember, and we're talking about this, all of these provisions, and I think the car loan is as well. These are temporary provisions that are really only gonna last depending on, but for the most part, from 2025 to 2028. So there's gonna be a 4-year window where we're gonna get these deductions, and then unless Congress, repasses a tax bill and makes some of these things permanent if they were popular, they're gonna go away. So it's important to understand that these are short-term provisions, not long-term. We'll get into some of the permanents, but these are in that short-term, here for now type category. This one is gonna be interesting. So, most individuals who are hourly workers understand that the work week is based on a 40-hour week, and if they worked more than that, they would be paid overtime, which is traditionally time and a half. So, the difference here now with this deduction is that you're still paid time and a half by your employer, and all of that sort of calculation stays the same as far as your paycheck is concerned. So I think that's important to understand that for people who are thinking, "Oh, I earned overtime, it's supposed to be tax-free." That's not how this is gonna work. You're gonna still just earn the money from your employer at the paycheck level. You're gonna receive your paycheck with the overtime, all the same as you always have. Nothing happens until you go to file your tax return next year, and then you're gonna be able to exclude, and again, this is one of those, like, between the line things, you're gonna be able to exclude the half. So, that's also a little bit different because remember, for a lot of people, they're thinking no tax on overtime, and they're thinking, "Well, I got time and a half, so the whole thing is excludable," but it's really only the portion for the half, the little extra that you
right.
got, that is the part you're gonna be able to take as deduction.
Exactly. That's where, I mean, it's still generous. This could be this could have be something where, I don't know. I mean, if I represent an hourly wage based area and I advocated for this, I would be a popular thing when they go to the voting booths and at the midterm election or in 4 years. We'll say that.
Yeah, I think it'll be interesting to see how it plays out. The one thing I wanna say with this from a professional perspective is that I think that it's important that we are talking about it because believe it or not, we may have a lot of our taxpayers that are clients and maybe it's where, we have taxpayer spouse and one has a full-time job, and that's the one where, they're on salary, something like that, but then maybe the spouse has while they're raising small children, has the part-time job, and they, though, may be receiving overtime, and it's not something that we're normally accustomed, quite honestly, to caring about. So, this is gonna be one of those things to look for. There is gonna be a separate place on the W-2 where they're gonna report this for us, but I'm gonna say this, I will be super cautious about whether our payroll companies will be appropriately reporting this for 2025 specifically. I think by the time 26 comes around, this will happen really well, but for 25, I think the caution point for our practitioners out there is you may have to be asking people for their pay stubs because this might not get reported well on these W-2s. The payroll companies just got this new law, and now they have to change their software. We all know how that's gonna go. This I think it's gonna be a heavier lift for this tax season coming up than in the
Yeah,
future.
we've talked, and it's funny. We talk about a couple things when you're advising your clients. What you might realize is the withholding tables didn't change in 25, so your clients will probably have a larger refund with the same amount of W-2 wages and all the facts the same in 25 than 26, because I think by 26 they're probably going to change. So meaning your client had earned overtime throughout the year and still now, and they're probably still getting withheld. And that misconception that they think it's taxed at a higher rate. No, they're just withholding is at a higher rate because it's annualized. And I see that I could see that problem in a year and a half from now when a taxpayer comes into your office and says, "Hey, they don't look at their W-2, right? Why is my refund so much less?" So it'll just be interesting, how this all plays out.
Yeah. Yeah, it's gonna be fun. Lots of questions this year for sure.
I agree. So during the election, there was some banter about no tax on Social Security. And instead of that getting enacted, it's kind of like when you you start out with their spouse, say, "Honey, we're gonna go out for an awesome dinner on Friday." And then it's like Friday morning, you're kind of tired. And then at noon, you're like, "Dang, I wish I didn't even offer that. Maybe and then you end up going somewhere okay, but just getting a carry out because you just want to stay home. So we start off with there's no tax on Social Security. We end up with the temporary senior deduction, which could be beneficial for many. This is one of those, again, between the lines deductions. And I've got another thing I want to point out just as a practitioner, to practitioners. I've been talking to practitioners about how we're going. I mean, this is extra work for us as a practitioner. And how are you going to underwrite this? Like, if you're on subscription, that's one thing. You're value billing, and if it were me, I would seriously consider having some type of additional charge for any clients that have a Schedule 1A, which is now the new schedule for all of these type of deductions, because you're not penalizing people that don't, but there's definitely more thought, more work. And it's not just the work, it's going to be the explanation of taxpayers don't understand things get phased out. And all these phase outs are different. I don't know. What are your thoughts as we jump into that?
Yeah, I mean, if you're listening and you're a practitioner, hear me now screaming it from the rooftops. You need to raise your rates. We have a serious problem in our industry, and many of us are aware of it, in that we have an aging population of practitioners, and we have a huge underbilling problem. And we have people doing tax returns that are doing them for way too cheap. And if you're sitting and listening to this, then you're automatically, because you care about your education, and understanding how the tax code works for the benefit of your clients, you're already in the upper echelon of practitioners. And so for me, I just want you to hear from somebody else to say that you need to value yourself at a higher dollar value, because this stuff is hard, complex, very increasingly, a lot of work, and you should be well compensated for it. And so please do not sell yourself short. Please raise your rates. Absolutely need to make sure that this is clear. And I do not care for the few people that are going to whine. Most people, believe it or not, you're afraid of something that's not going to happen. You're afraid of your clients whining. They will not. It's fine. Please raise your rates. So
Absolutely. And again, as a practitioner, it's not that we begged for a tax law overhaul, right? There's some beneficial things. There's some great planning opportunities, but we're rolling with what we have. I mean, shoot, you guys, I know you and another topic, but I know you and your family own a farm, and when eggs got expensive, or maybe they still are, who knows? There's egg surcharges on menus, or chicken surcharges on menu. So honestly, I would do a Schedule 1A surcharge for any client that
there
has
you go.
this schedule. But
However you do it, just charge more for it.
yes,
That's all. That's all I
I
care
like
about.
it. Well, tell us about the temporary senior deduction. Who's going to receive this in general?
Yeah, so this was, you mentioned this got a lot of weird press, and not really helped by anybody in the press, but this is a senior deduction. This is going to be available for taxpayers who are 65 and older, and it has no effect of whether you are collecting or receiving Social Security. So I think that's important, because a lot of people are saying that it's no tax on Social Security, and that's not what it is. It's for those who we consider seniors, which are 65 plus, and you're going to get $6,000 for each individual in the household who's over age 65. Now, there is a phase out on this. So same thing, we're going to have that phase out that happens at 75 or 150 on this, and it starts to phase down. Couple caveats for this: married filing separate Not a good situation for this. You're not going to get it. Everybody's got to have a social security number. So that's important if you've got some ITINs or things like that involved in your taxpayer situation. It's a 4-year window also. Here's where I see the opportunity. We all know if we're working with older taxpayers that there's probably certain of our clients who are really not in super high tax brackets. And right now, for the next 4 years, they're going to get, if they're a married couple, an extra $12,000 to take off of that total income that they pay tax on, which might in fact bring them almost down into the 10% or even below, zero bracket type thing. Okay. Is this an opportunity to be having planning discussions about the nature of the assets that your clients have? I could see this being a real good opportunity for some Roth conversions to be happening in this next 4-year window because of this additional $12,000.
I couldn't agree more. I mean, we're looking at 25, 26, 27, 28. There's 4 years. If you're married joint, you could ultimately, you could ultimately take almost $58,000 of income tax free, maybe raw. And even
That's
if your
right.
client doesn't need the cash, convert those pre-tax dollars to a Roth.
That's right. So this is going to be a $50,000 opportunity, if not more, because realize that with some people with these deductions, it's going to bring other things down. But I agree. I think the planning opportunity and the communication to clients now is, particularly those who may not work with us with a financial advisor, realize that for a lot of our clients, we are their only one professional advisor in their life. This is the opportunity to be communicative and express your value by having conversations, sending out newsletters, doing videos, hosting events. I don't care how you do it. Of course, I'm doing all of them, but like talk about this because this is the opportunity for your clients. And then you look like a superhero. Who doesn't want to be a superhero?
Everyone wants to be. It's just which one. That's another episode. So Kelly, so it's good to be over the age of, by the way, wouldn't it be nice if all these phase outs were the same amount? Just personal thought out there. And then, yeah. So the government's telling us,
Right. It's why you should not spend too much time
oh,
memorizing
heck
any of
no.
these numbers because they all change. I have no idea. I'm not going to pretend like I can remember them all.
Well, we're seeing a theme too. Most now, a lot of these credits and deductions do require a social security number. So that's telling me that there may have been some improprieties. It's telling me that there's a focus on making sure the deductions and credits are going to getting allocated to U.S. resident taxpayers. And there doesn't really that's just what it is, right? So it's okay, that's fine. Hey, I like that the government considers a mature age person 65 because John always makes me feel old. So I feel pretty good. I've got some, I just graduated this year. It was one of the most proud days of my life when I rolled into Kroger and I got my one a day vitamin and it was Centrum Silver. Yes, I got to age 50. So now, oh gosh.
You know what, sir? When it comes time, and I chime in very few times in this podcast, right? But this one I can't leave alone. When it comes time for you to be a potential AARP member, I think I'm going to be the one to hand deliver you the invite letter. I'm going to like interject, cut off the mailman and hand it to you. It'll be fun.
I think the AARP also like starts at 55 now too.
Well, there's some going. My wife received AARP information. And she's 4 years younger than me.
Okay, maybe it's 50 then.
I don't know.
Chris.
She's only 46.
Some people think you're old.
That's okay. You know what? There's certain sports that being 50 and older could be beneficial when you get into the senior
There you
bracket.
go. I'm not there yet.
Oh, I know. I'm way older than everyone here. So
Wiser.
the government says, yeah, it's better to be mature aged. Oh, it's also better to crank out more kids. So expanded child tax credit, right? Because that extra $200 is really going to help out. But no, I think this is a good thing for families, and really, this has a higher threshold. But you can tell us a little bit about the child tax credit.
Yeah, so this is great, and like you mentioned, so I think we're hitting all of the different ages and ranges with these tax cuts, which is why I think, people the OB3 has a ton going on in it, and it's good to understand that these changes are going to hit almost everybody in every category. So with the expanded child tax credit, remember that we were actually operating under a current expanded child tax situation. It was $1,000. When go back in the Wayback Machine, it was only $1,000 per kid, and we all know that kids are super cheap. So $1,000 pretty much covers their life at $1,000 a year. That's about all it costs. So they threw that up to 2,000, and that's where we've been. There might have been a period of time where it was 2,500. We bumped it around during COVID, maybe. It's been at 2. Now it's moving upward, and it's going to index with inflation. I just think this is nice and logical. I wish a lot of these things kind of index to inflation. We're seeing this a little bit more. But what this just means is that maybe, if I'm wishful thinking, we're not going to have so many tax changes to affect things that should just naturally move forward as people's incomes raise and grow because of inflation. And so maybe we won't have to see as many structural changes to the tax code if they're tying these things to be indexed with inflation. So I think this is a smart move. Um, that credit's gonna go up to 2,200, so not a huge change. The refundable portion goes up to 1,400, little change there as well. Both of these are now indexed, which is very nice. And so, again, and then we have some AGI limitations, of course, 2 and 4 in this case, 200,000, 400,000, but, that's, you know.
Well, yeah, I'll give you an example of something that was not indexed to inflation was the capital loss carry forward deduction of $3,000 for married joint. And it's like, come on, you know.
That deduction has been the same for in I maybe as long as I've been alive, I
Yes,
think.
definitely is the at least 20 years as I've been doing this.
Okay.
It's just
A
nuts.
long, long, long time.
So, but your point is well taken. It might not seem like a big deal, like index for inflation. Okay, it's a couple percent more. Well, what's a big deal? It went up $150 a child tax credit. Well, once you have it stuck at the same spot for 40 years or whatever, then it is a problem.
Right.
So anyway. Now,
And
oh, go
and I
ahead.
think
Okay.
I'll add, because I don't know if you mentioned it in here, and if not, we'll talk about it, but one of the other things that goes along with, the incentive structures, obviously, we're talking about child tax credits. There is another little temporary provision in here for new babies born from 25 to 28, in addition to this child tax credit, called the Trump accounts, and that
Mhm.
could be a whole session to unpack, but those are also a real, just kinda carrot being hung there, which is gonna start with seed money from the government for new babies of $1,000 apiece, and that's gonna just be a temporary thing as well, but those are out there.
Right, exactly. And I did listen to your podcast episode. You made some really good points on those Trump accounts, and there's still some clarification. I know the W-2 changed because employers will be able to contribute to those Trump accounts. So that's going to be something I think we'll probably do maybe something separate on just because that's so new, something
Mhm.
different down the road. But yeah, absolutely, those Trump accounts are going to be something to really to think about. And maybe we're going to have a new maybe there'll be a 1099 RT one day. I don't know. It'll be a new 1099 R. So Tax Cuts and Jobs Act came along in 2017, increased that standard deduction. So but that standard, which made I saw a stat that about 30% of people itemized before TCJA, and now only about 10% of people itemize. Now, a lot of the clients that people listening to this podcast do itemize, but I mean, a lot of people don't, and so with a higher standard deduction helps out a lot of people. Well, I believe that was made permanent with OB3. Is that accurate?
That's right. Yeah, so, again, it's if you're a younger tax professional and you're just getting into this world, you maybe weren't even aware of what the tax code looked like before 2017. But for those of us who have been around a minute, and either don't have hair or it's slightly graying, we remember what the standard deduction was, and that standard deduction was only, about $6,800. And then we had this other weird thing called an exemption. And so a lot of people forget about this because it was like 8 years ago, but the exemptions were then like a per person offset if you qualified. So that got put into place where we basically doubled the standard deduction and removed exemptions. And so a lot of people didn't think a ton about it at the time, but we as tax pros knew if we were thinking about it, that this was actually temporary. So if we had not made this permanent in OB3, we would have reverted back to those very much lower numbers. And so this is a good change. This is going to be a great permanent effect. And really, let's think about what this means. For a married couple, the first for 2025, you have this number here, $31,500 that you earn as a married couple is tax-free. That's amazing. And so, it's important to look at that and realize that that's what that standard deduct does, and gives now that first 30,000, or if you're a single person, the first 15,750, you get to earn in a tax-free mode. And then now after that point, you start to take away with deductions and, pay tax above that.
Right. I mean, and then piggyback that on to maybe the extra $12,000 if you're a senior. To get the senior deduction. I mean, it's pretty generous. And sometimes there's some sentiment around taxes, just, the wealthy, high asset, high income people benefiting. I feel like there's provisions all around OB3 that help a variety of different segments of taxpayers. Let's put that way.
That's right.
Yes.
Mm-hmm.
Well, let's look into 2026. What are some of the changes that we see, taking place in the 26? One of them is the expansion of the child independent care tax credit, especially for lower and moderate income households.
Yeah, I mean, so this one's going to be good. I could argue that this one doesn't maybe go far enough, because anybody with small children, they kept the expense limit the same here, which, can be a little bit, I would say, disconnected from the reality of how expensive childcare is. But it is what it is, so we'll take with it what we can get. But what it is that for a dependent child, if you have both taxpayer spouse working and earning income, or if one is in school, so this doesn't work for households where we have the benefit of one spouse staying home and not earning an income and one going to work. But this works if both are working. Then $3,000 a kiddo in expenses. And now starting next year, the credit rate, which had been 20%, right?
I believe it was 20 was
I
the
don't know what it was,
max.
but it's going to go all the way up to 50. So we're going to
Right.
get up to $1,500, and that goes in a credit, which is important to realize, because remember, when we were talking about everything previous. Well, the child tax is a credit. Those were deductions, a lot of those. This is a dollar for dollar credit off the tax. So $1,500 in tax credit is actually a pretty nice bump.
That is.
And so that's really going to be helpful, particularly for those in the lower end of the earning spectrum here. And they've made this credit purposely to be beneficial to those in the lower income brackets.
Agreed. The next one is the dependent care flex spending account maximum. So I think the theme is childcare is extremely expensive. Luckily, our children are not in the childcare age anymore. My wife might think I am, but at least mine are not. John has to have a daughter in that childcare age.
I'm in the trenches.
Yeah, he's in the trenches. The child independent care credit, unfortunately, quite frankly, it does phase out pretty quickly. $150,000 for married joint, $75,000 for single. Now, that was a decent, I'm not saying that's not a good living. However, when you start, there's no indexing for where you live. Like if you're a single parent, living in Southern California, you're probably scraping by at $75,000 where you're going to phase
That's right.
out in all reality. So the dependent care FSA allows people to put money in pre-tax, like through their W-2, and that limit increased, I think, a decent amount percentage-wise, and that's effective 2026. So yeah, can you kind of talk on that a little bit, how that the difference between the dependent care FSA versus the child independent tax
Yeah,
credit.
so remember, and you can use the two in tandem if your expenses go over, but if you have available at work what's frequently called an FSA or a flex spending account, and it includes an option for dependent care. I always tell our clients this is the first place to start. Go to your employer, enroll in that plan, use that because it's coming through pre-tax to you from your paycheck, which is the number one best way to get this. So get all that income to come through pre-tax, and then you basically get your bucket of money and you spend it on your dependent care expenses. And again, when we say dependent care, this is not just like baby daycare. Preschool programs frequently qualify for this, daycare, after school care, certain things like that. Like those are all included in this conversation. So the dependent care FSA is actually, I would rank that above the dependent care credit
Yes,
because it's going to have a better bang for your buck. And now that limit um, for a married couple is going to be $7,500, $3,750 per, and that is a bump. It was $5,000 and $2,500.
absolutely. No, I think that was very generous, and like you said, they can work in tandem. So fill up that FSA bucket because remember, a lot of these other deductions are based on your adjusted gross income. If you're contributing to so when you're consulting your clients, the child tax credit, child and dependent care credit is a credit that reduces your tax, but it doesn't those expenses don't reduce your adjusted gross income, which could drive a lot of these other deductions. So it's very interesting when we talk about marginal tax rates different than tax bracket, and it's very important to understand that.
Yeah, that's right. And that's a really good point is that the FSAs are not going to be income limited, which, that's important for some people to understand that if you have that options at work, take those because frequently those are the places where regardless of how much money you earn, you can get into them. Whereas some of these other things, they keep throwing in income limitations. And so particularly if you're right in that kind of mid range where I see a lot of middle income people get stuck, they make a little bit more money and then they lose a credit, and it just, doesn't work out well in their favor. So if it's at work, take it there first.
Right. And you've probably seen it. There's been times when someone in that middle income range, who knows, they could have kind of their incomes at, let's say, 140 married joint, everything's humming along, they're qualifying for all the credits, and maybe they inherit some savings bonds from a deceased uncle or grandmother that they don't come to you and talk to you about planning. They cash them in, extra money during the holiday season. It's $20,000 of income. That just blew up a lot of their stuff, right? That just blew up a lot of their credit. So, yeah, so as a tax professional, you really need to think about that forward thinking and planning for your clients. Um, this next item, I think, is going to continue to be expanded. We are seeing a trend of the expansion of 529 plan benefits. Starting from it being very specific as far as what the expenses could be used for. Now it continues to open up and also continues to have a larger distribution amount tax-free if you have qualified expenses. What are even eligible expenses? And there's even that, now this wasn't necessarily OB3, but we know that there's that Roth conversion opportunity down the road for 529 plans.
Yeah, 529s are definitely no longer what they started out as. And, same thing. History helps you here is that they used to just be kind of after tax savings vehicles. Maybe the state would give you a credit, and even that was limited. And then you would be able to have the money to grow tax free if you used it for college. And either, because they were so popular or because somebody lobbied in the right organization, they've continued to evolve in what they can be used for. So we saw a couple years ago with, I want to say Secure 2.0, where it went where now we have K-12 tuition that can be taken out of 529. So we can have this money put into a 529 that can now be spent for K-12 tuition, which is super helpful. That now has been doubled. It was $10,000 a year. They took it to 20.
Right.
Huge. So that's great. And then this one I think is really cool. And so I want to just remind if anybody's listening here and you are in the younger category of a tax professional, and maybe you're blessed enough to have a 529 with some money in it, you can use this now for test prep and credentialing in a professional setting. So for us, we have professional credentials. These credentials can be paid for with $529 now. So I also hope that this allows for an expansion of some professional education for people. Maybe, an ease into the workforce for that younger generation that maybe has a couple extra dollars sitting in that 529 and now can be used for these additional, kind of exam fees and stuff like that. Because the EA and the CPA exam particularly is very expensive. And so it's, cool. You can use this for that.
I agree 100%. Now you have more outlets for that. Um, there are a little bit of changes to health savings accounts. I think that there's a little bit of an expansion of what is a qualified high deductible health plan. I'm always, to be quite vulnerable here. I'm always a little uncomfortable talking to clients about HSAs, not because I see a huge benefit in them, but I also don't want to misadvise them as to figure out, are they even eligible? So the eligibility requirements loosen a little bit. As a tax professional, and I'd love to get your take on it, I tend to talk about the tax benefits of it, but I always make sure they talk to their health insurance advisor, their employer, to see if they, they have what's called a high deductible plan, and they can make HSA contributions.
Yeah, so I'm a little more bullish on these HSAs. These might be my absolute favorite um, mechanism in the tax code. I love the HSA so much because it's one of the few things we sort of get that just has all of the tax benefits wrapped up into one. And I don't know who thought them up originally, but I love them. They're triple tax free. They're great, and this expansion now really allows people that were being excluded because they wanted to stay in the super cheap monthly fee for health insurance, like the catastrophic or those bronze health plans, as we've now categorized health insurance into, bronze, silver, gold. Now people who want to pay the absolute lowest possible monthly out of pocket premium, a lot of those plans are going to be expanded to be included and be considered for high deductible status, which is going to allow you to couple it with a health savings account.
In
Why this is so important is that you can basically make your out-of-pocket medical expenses tax-free.
Right. No, and you agreed, because it's pretty rare someone deducts medical expenses on the Schedule A. It's pretty rare they go over that threshold and still itemize. The nice thing with HSAs that's coming through is that you're going to be able to utilize, there are some what we boutique or white glove subscription model primary care physicians that are outside of the health insurance. Basically they're private pay and they have their own subscription model, and those expenses are now going to be eligible for HSA. So I think that's good. The limits did go up, and I like that they continue to go up. With now almost $9,000 in family coverage, and that doesn't include catch-up contributions as well.
Yeah, and remember, one of the little tricks here with the HSA that I think a lot of people forget is that with HSAs, these are, they're individually owned, like bank accounts, right, for the individual who has them. But remember, when you're advising your clients, that because some people will say, well, they're not going to spend that much in expenses. That's fine, because you can get into these without income limitations, which is helpful. If you have somebody who's in the higher income bracket, they're able to get into it. If they absolutely cannot spend the money out of the HSA. Once you're over, I think I think it's 59 and a half, but like all the retirement accounts, you could just take the money out like a normal retirement account distribution. If worst case scenario, you were the healthiest person around, you couldn't find any dollars to spend on anything medical. And remember, medical's a broad term. So don't look at it just as a health savings account. There's also a possibility to look at it like a secondary retirement account, which then I just think gives it so much more usefulness.
I agree. No, HSAs are pretty underrated, I think. Well, we went through a lot of the provisions that are going to be taking place in 2025 and 26. I want to just walk through what's good permanent and what's temporary. So most of these we've already talked about. It's just, because each new rule has a couple different attributes. It's either what year does it take effect, and is it here to stay, or just here for a good time, depending on what happens. So, as far as permanent permanent extensions, this is something that's important. We talked about the standard deduction being higher, but tax rates are supposed to go way back up after the TCJA expired. And now those what we call larger tax brackets have been made permanent.
Yeah. So remember, the word permanent in Congress is only as good as the paper it's written on. So when we say permanent, that is until somebody else comes along and changes it and, writes new rules. But for now, this is not one of those sunsetting provisions. And so, yeah, those brackets are permanent. And again, why does this matter for us to know? As practitioners, if we have knowledge about what's coming in the future, we're not fortune tellers, but it does help to have some good data to say, hey, next year, based on XYZ, you're projecting to move up a tax bracket. It's very helpful if I know what that tax bracket is.
Right.
And so that's where this is going to become helpful, is that now we know what the brackets are and we know what the future ranges are going to be with income. So we're going to be able to help our clients plan better.
I agree. We talked about the the child tax credit baseline being permanent now, so that's a positive for families. What's interesting with that child tax credit is that cliff of a 17 or under 17 years old. So that but just 17 kind of gets screwed, I guess, for lack of better terms. You got a bunch of college credits, but you also have that child tax credit. But that's just something to be aware of.
Don't you have a kid in that range, Chris?
I do. I have a 16, 15, and 12-year-old. So yeah, we're
Yeah.
gonna have that.
That's 17, man. It's like they're still in high school. You don't get a child tax credit, but they're not in college. It's just that weird, expensive year.
It's a really weird. It is an odd one. Hey, our friend, the salt tax deduction. That we hadn't talked about yet, but that's it again. And I agree with you, quote unquote. Some things are temporary, some things are permanent. This one's a temporary change. So ultimately now, with the PTET being, allowed, I guess you could say. I don't know how to better say it. And the increase in state and local income tax deduction, we're going to see a lot more clients itemizing. And and really, especially for business owners, there's really no excuse you shouldn't be deducting your state tax.
Yeah. I mean, so I don't know and when you said PTET, so remember that's that pass-through entity tax. That's about, I want to say maybe 29 or 30 some states that have a tax and have enacted that workaround. And just remember, this is not it's a legal loophole. So sometimes people get scared of the loophole, but the PTET is very legal. It is very by the book. You are allowed to do it. Couple that with the SALT now, with this expanded SALT. Now, the expansion of SALT is temporary. We're going from $10,000 to 40. When we say SALT, state and local tax, that's going to go up to 40. And then there's some phase outs that maybe are going to occur in there.
Mm-hmm.
And then after what do you have on this? 2030,
2030
it comes
goes
back
back.
to 10.
Mm-hmm.
Again, nothing is consistent. I love it. I love when we don't keep anything consistent.
Well, yeah, that makes our lives easy. Hey, at least we're not coding tax software. How
That's
about
right.
that?
Why you should raise your rates. You got to remember all this stuff in your head. No.
Yes. So the mortgage interest deduction stays in place. PMI is now going to be deductible starting in 2026. Especially the interest rates being higher, housing costs being higher. I think more people are subject to that private mortgage insurance.
Agreed.
That could be something good for your clients. But I would say one thing a lot of tax professionals missed. I would bet if you have a firm that's preparing a decent amount of returns, we've all probably missed it. We probably missed the mortgage interest deduction cap, right? We may have accidentally allowed a client to deduct too much mortgage interest based on their acquisition debt cap. So that's something to think about. I do want to touch on, we're wrapping things up here. We had so much good stuff, but charitable contributions have gone through a change, especially in 2026 here, right? So they're now, a few years ago, I think it was during the pandemic, we had that truly above the line charitable contribution deduction, then of course every one of your clients at least had a couple $100, $200, $300 of charitable.
Everybody was very charitable that year.
Yes, they were very. With charitable contributions, there's going to be a little bit of a change in a floor put in. Maybe people are just getting a little fat and sassy with this deduction. I don't know.
I don't know. I'm really frustrated by this one. I got to be very honest, because I don't quite understand. So, if you were a generous giver and you were already taking the itemized deduction for charitable, I'm really not sure why you threw in a floor,
I mean,
because these people are already in the highly generous category. So, I'm a little bit frustrated by that, and I do think it's going to catch some people by surprise. So remember, both of these changes these are not happening yet. These are both 2026 changes. So a lot of people are going to have questions about them. We've got two new things happening. So if you mentioned, if you're a non-itemized taxpayer, you're going to get another above the line deduction for $1,000 or $2,000, depending on, and it should say that's the max. So the actual deduction is actually how much you gave away.
right.
It's not.
Oh, we forget about that, right? We think it's standard. You love these clients. If you're listening to this, man, we'd love to, especially if you watch this on our YouTube. Give us a holler. How many clients have you seen come in and say, "I want the standard charitable donation deduction"?
Right. I say, how much did you give away? And they're like, what's the standard? I have no idea. I said, whatever you gave away. That's what the number is.
Oh, man.
So we have that 1 and 2, and then charitable. Again, we're still up at 60% of AGI. So for our big givers, there's still a really high percentage that we can give away. But we do have this new 0.5% floor. If you think about this like we think of medical expenses. You have to exceed the first 0.5 before you get to take the deduction. So that's going to add a little complexity for sure. I'm a little bit, like I said, frustrated by it. I don't love a limitation on charitable contributions, because I think for those who give, that one, just shouldn't really be taken away. But nobody asked me, so that's what it is.
I know. Remember those 2106 expenses that we all loved? Yeah, you know it. You're listening to this. You had that police officer that miraculously bought, 4 new uniforms every year and had them dry cleaned every time he or she worked, and also bought a lot of ammunition and went to the driving range. Yeah, went to the gun range only for work purposes. Point is, I think the IRS saw through all that. Nothing. We love police officers here. We're just saying a lot of those unreimbursed employee business expenses, even though they would put a 2% floor in back in the day, may have just been inflated a little bit, and they're gone. And guess what? They said, you are permanently gone for now.
Yeah, I don't mind this one at all. I thought this was the best change for TCJA. I'm happy to see it go. I thought this was a very, again, broadly subjective sets of expenses with a lot of people who did not keep good books and records. And so I'm happy to see this one go. Great.
Me too. It was a lot of times a lot of work for not much squeeze. A lot of juice
Exactly.
squeeze for not much juice. You know what I did like, though? Educator expenses. Now, still, as my wife is being an educator, $300 is not much. However, they did broaden the definition, and we're talking about the educator expense deduction, which is a above the line deduction, not between, not the purgatory, and not itemized. And now coaches, administrators, because for instance, my wife is a teacher. She became a school counselor a year and a half ago. Technically, in 2024, she was a school counselor, and she didn't have "quote unquote" classroom expenses of a teacher. Would have to determine and look at my tax return to see if we actually considered it that. But now, as an administrator or a counselor, or the thing about speech, speech specialist, for lack of a better, I think I need one, right? Any of the special educators that come in and help, they should get that same deduction, in my opinion. So congratulations, you received that. Just kind of wrapping up, we talked about those temporary provisions, right? here for a time, not a long time. Who knows? The car insurance deduction, the no tax on overtime, no tax on tip, and I'm going to refer to it as our our mature age deduction, all with different phase outs. And I would love to, as we wrap up, kind of get your opinion on some of the themes of this. I mean, they're requesting VIN numbers, which is nice. I've been doing this long enough where miraculously, especially in Michigan, everyone donated a boat or very expensive car every year, took a deduction for it as a non-cash deduction. A lot of that stuff's been cleaned up, where we now need VIN numbers and social security numbers for many of the credits and deduction. Kelly, any other final thoughts or any takeaways from these individual provisions, or maybe one or two tips you can give that we haven't given already to fellow tax professionals as they work through these changes?
Sure. Yeah. So I think that you kind of mentioned it. One of the things that I think the OB3 does is it expands some of the provisions for some of the things that we on the tax professional side have seen abused by less than, shall we say, scrupulous tax preparers or advisors over the years. And so I do think that some of these compliance provisions that we're seeing with social security numbers and VINs and things like that, I think that we need to look at this as a positive, because if you're on the side of wanting to do what is right and true, but also in the best interest of your clients, you should see this as a positive. You should see it as an opportunity to, again, elevate yourself as a professional, raise your rates to be appropriate. Do not worry about these people that are fly by night charging, $30 a return. Those are not the people you should be concerned with, because they don't care, and they're going to get flushed out by a lot of these technical provisions anyway, because they weren't following the rules. So don't worry about those people. Worry about being the absolute, utmost best professional in your field. I think some of these things are going to be great for flushing out a lot of this. Really, there's a lot of bad out there, and I'm excited for the future.
Kelly, thank you for joining us. I know you've been on a number of the Teaching Tax Flow podcasts with us, and those are always fun. And again, Chris likes these ones because I can't talk a whole lot on this show. I kind of keep my mouth shut, and he enjoys that. Any opportunity he gets, he takes it. But thank you for joining us.
You're welcome. It's fun. Thanks, guys.
Absolutely. And if anybody's more interested in something else behind or I should say in beyond was probably the better word here with this podcast, this topic, feel free to reach out to us. That's the MRR Institute, or we're going to see some show notes here. I always reference them some way or another. So a couple links in there. Check them out. Kelly's contacts in there as well. But yeah, get the free CPE. Don't be lazy. It's kind of like my favorite tagline, I think, on all of our shows. If you're that lazy, you can't click on a link in the show notes, well, then you got bigger problems. Probably shouldn't be driving either, because you're not about shortcuts. But yeah, check it out. We are there to help you. Kelly, obviously, you're doing all kinds of things as well to support some tax pros in this industry, advancing along. So everybody appreciates it. And if anybody is, again, interested in this topic, this show, subscribe to the podcast too. It's that easy. Do that. Again, don't be lazy. We'll see you back here again on the Mr. R Show.
You've been listening to the Mr. R Show, presented by the MRR Institute. For more content like this, be sure to check us out on YouTube for weekly expert tips. And don't forget to subscribe to this podcast to stay updated on the latest strategies for scaling and modernizing your tax practice. Looking for more? Contact us at mrrinstitute.com for practice resources, coaching opportunities, and a peer-to-peer mastermind group. Thanks for joining us, and we'll see you next time.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.